Hey folks, Tony from Kentucky. Welcome to my penny portfolio. Hope everybody's doing well. Hope everybody's making a little money. What about the markets today, people? S&P 500, I think first time it hit 5,300, like 5,308. Was that like 9 days in a row? I wanted to check out this article with you. Wall Street just gave its highest forecast yet for the S&P. Now, this is from BMO Capital Markets, Chief Investment Strategist Brian Belsky. I don't know how this is going to sound, but I'm going to let this read it to you because it sounds better than me. So listen to this.
BMO Capital Markets Chief Investment Strategist Brian Belsky boosted his year-end price target for the S&P 500, GSPC, to 5,600 from 5,100 in a research note on Wednesday, noting that momentum in the market is likely to persist. Belsky's 5,600 target reflects about 7% upside from Monday's close. We are comfortable with this because we believe the market is behaving in a similar fashion to 2021 and 2023, years where we did not give enough credit to the strength of market momentum, something we are trying to avoid this time around, Belsky wrote in a research note. Belsky is the latest in a string of Wall Street strategists to chase the 2024 stock market rally higher with boosted year-end targets. The high water mark on the street entering the year was 5,200, with the median strategist target at 4,850. But earnings have grown more than analysts have expected this year, and U.S. economic growth has largely surprised to the upside. 10 of the 15 strategists tracked by Yahoo Finance are now at or above 5,200 on year-end targets.
People. Now, so he's saying the markets are acting like they did in 2021 and 2023 when they didn't give enough credit to the momentum of the S&P 500. So they gave it a lower rating, and it blew by that rating in 2021 and 2023. So now this time he's not taking that chance because he thinks it's showing the same kind of momentum as it did then. So he's giving it a price target of 5,600. Now I don't think he's wrong. Look here now. Look how wrong these analysts at these big banks and places are right here. Look down here. There's like, 16 of them on here, and 10 of them has already got it wrong. So that just shows you. Look at JP Morgan. Now this is year end. Their year end targets. This is what they think it will hit by the end of the year. What are we on the 5th month? We got like 7 more months to go. And at the 5th month, we done blow past 10 of these predictions. Right here. Now, RBC and Barclays had it at 5,300, so they was close. But that's their year end prediction. I mean, and we're on the 5th month, so they're way off, really. Piper Sandler, 5,250. Fundstrat, 5,200. Goldman Sachs, 5,200. Citi, 5,100. Deutsche Bank, 5,100. Evercore, 4,750. Morgan Stanley, 4,500. And JP Morgan, 4,200. That's what they thought it would hit by the end of the year. Now these guys got a Bank of America has it at 5,400, UBS has it at 5,400, Oppenheimer has it at 5,500, Wells Fargo 5,535, and BMO 5,600. I'm telling you folks, by the end of the year, if this momentum keeps up, I think it will. I would not be one bit surprised if it goes beyond 5,600 by the end of the year. Here's the thing, though. Here's the thing. Okay, let's read this right fast.
The chug higher in stocks has come as investors have aggressively repriced their expectations for Federal Reserve interest rate cuts this year, after signs emerged that inflation isn't declining as quickly as economists hoped. Investors are now pricing in roughly 2 interest rate cuts this year, down from a peak of nearly 7 in early January, per Bloomberg data. This is in line with the Fed's most recent summary of economic projections, SEP, which showed that most officials saw the central bank cutting interest rates either 2 or 3 times this year. It has become clear to us that we underestimated the strength of the market momentum, particularly considering that investor expectations and Fed policy guidance have become essentially aligned versus the significant disconnect that existed at the beginning of the year, Belsky wrote.
Now, you know, I love this bull. Listen, some background on it.
Charging bull bronze sculpture in the financial district of Manhattan, New York, United States, on October 23, 2022. The sculpture was created by Italian artist Arturo Di Modica in the wake of the 1987 Black Monday stock market crash. Beata Zarzal Ner photo via Getty Images. Ner photo via Getty Images. More.
Now, this is the only kind of, see, there's going to be some kind of correction, drawback, or whatever. Listen to this part. Now, listen to this.
He acknowledges there will be bumps along the way for stocks. Using historical analysis, Belsky believes that the market likely hasn't seen its worst drawdown of the year yet. Belsky's work shows the average pullback during the second year of a bull market is 9.4%. April's recent pullback only reached just over 5%, but given the index's rally off the April lows, Belsky is now convinced that should a more severe pullback happen, it will likely occur at higher index levels than we previously anticipated, providing a higher landing spot for the S&P 500. After a rebound, and with the level of strength seen in stocks to start the year, history says further gains are likely ahead. In years where the S&P 500 rallies more than 8% in the first 5 months of the year, as it's currently pacing to do, the index gains more than 7% to finish the year 70% of the time, per Belsky. Based on historical trends, performance this strong to start the year tends to continue through year-end, Belsky wrote.
Now, it's what the, historically, the drawdown of the year, but his work shows the average pullback during the second year of the bull market is over 9%. And April's farthest pullback was only 5%. So we still may have that to come. I hope not. But his work also shows, if that does happen, that the index is already at a higher rate than it would be. So the S&P 500 will have a bigger landing rebound. So that's good. Plus this, in the years where the S&P 500 rallied more than 8% in the first 5 months, the indexes finished more than 7% that year, 70% of the time. So that's good. So if we have a big drawback, more than 5, 6, 7, 8%, 9 even, try not to freak out like I do. Try not to. Because if you got good companies, you got good stocks, they're going to go back up. Just look at it as maybe a buying opportunity. Get your average price down even lower. Maybe some of them stocks and them good companies will drop below their fair value. Who knows? Then you got a real buying opportunity, right? It's like going shopping with stuff on sale. That's the way I look at it. And just think, if you're invested in good company, and I get people want to get their money out. So, have you ever heard of this? By the way, the S&P 500 finished at $5,308.15. It was up 1.17%, over 61 points. Now, if I ain't mistaken, that's the first time S&P 500 ever hit 5,300. So that's an all-time high, which is awesome. But check this out. Yeah, circuit breaker. That's it. It's called circuit breaker. Circuit breaker stock market. Now, there's 3 levels of this circuit breaker, right? If level 1, if the S&P 500 drops more than 7%, if it drops 7% or more, they will halt trading everywhere in America. Halt trading for 15 minutes. Now, then the second one I think is like 13%. They will halt trading again for 15 minutes. Then the third one, right? Okay, here it is. The S&P index performance triggers 3 levels for the entire market, which are level 1, trading is suspended for 15 minutes if the S&P 500 declines by 7%, but not after 3:25 p.m. Level 2, trading is suspended for 15 minutes if the S&P declines by 13%, but not after 3:25 p.m. And level 3, trading is suspended for the rest of the day if the S&P declines by 20%. So if we got up one morning, 9:30, and was doing our thing on our portfolios, and by noon the stocks had dropped by 20%, they would halt trading for the rest of the day. That's called circuit breaker, and I had no idea about that till the other day, when that AMC and GameStop was going wild and it was real volatile. At some points you couldn't, it had up there that other places are halting trading on these, but not Robinhood. You know, it kept saying not Robinhood. That's how I went to the info thing and found out about this circuit breaker. I did not know that. I didn't know they do that, and I hope that don't never happen. Anyway, but if it's after 3:25 and it drops 7 or 13, they won't do nothing about it. But if it drops 20, no matter what time it is, they halt trading for the rest of the day. If we got up at 9:30 and by 10 o'clock it dropped 20%, we wouldn't be able to trade the rest of the day. Isn't that wild? Anyway, folks, I just wanted to get on here and holler at you, let you know that. Thanks. Till next time, take care of each other and yourselves.